Picture this. Your Mumbai flat has been locked up and empty for 4 years. You haven't collected a single rupee in rent, just ghost town vibes. But today, a tax notice literally arrives at your door demanding income tax on that exact empty apartment. Sounds totally impossible, right? Well, welcome to this explainer. Today, we're unpacking one of the wildest rules in Indian real estate taxation: how the government actually taxes you on income you never even made. We're going to completely demystify this so you can project your wealth. So let's just dive right into this shocker, because it's a scenario thousands of property owners are facing. You've got this flat, it's locked, it's generating zero cash flow, and yet Section 23 of the Income Tax Act swoops in and hits you with what we call a phantom rent bill. Now, you're probably wondering, why on earth does this happen? Well, the tax department isn't just looking at what you actually earned. Nope, they're looking at the earning capacity of your asset. Basically, if you own multiple properties, the tax law just assumes you should be monetizing them. And if you choose not to, they're going to tax you as if you did anyway. Okay, here's your 10-second explainer. If you own more than 2 residential properties, the extras are treated as deemed let out under Section 23 and taxed on notional expected market rent, even if they are completely empty. It really is that simple. The law basically gives you a free pass on 2 houses. You can declare 2 properties as self-occupied with 0 gross annual value. But the absolute second you own property number 3, 4, or 5, boom, the taxman treats those extras exactly as if you rented them out to a tenant, whether there's an actual tenant living there or just cobwebs. Now, what's really wild is how these rules completely shift depending on where you live, especially for talking about non-resident Indians. The contrast here is huge. Residents are capped at 2 self-occupied properties, but for NRIs, they get an amazing choice. NRIs can claim up to 2 properties as self-occupied and pay absolutely 0 tax on them, even if they live abroad and those flats just sit there totally vacant. You don't even have to physically live in the property year-round. You can just leave it empty for when you visit India or let your immediate family stay there. It is a massive perk. So, the absolute key here is understanding this multi-property trigger. You might be cruising along just fine with your 2 tax-free homes, but, life happens. Maybe you inherit your parents' house in Pune, or you decide to pick up a sweet investment flat in Delhi. The second you add that 3rd property, you instantly activate the phantom tax. Now you're forced to pick which 2 properties are your self-occupied ones and which one gets hit with the deemed let-out label. Pro tip right here: always choose the 2 properties with the highest potential rent as your self-occupied ones. Leave the cheapest one to face the tax man. Now, I know what some of you are thinking. I'll just not tell them it's empty. Yeah, scratch that idea. The days of hiding vacant properties are totally over. If you don't report this phantom rent and Schedule HP of your tax returns, the Centralized Processing Center, the CPC, will definitely know. They are constantly cross-referencing your property holdings to your Annual Information Statement, the AIS. If they spot a 3rd property and see absolutely 0 rental income reported, their automated systems are going to flag that mismatch instantly and shoot a tax notice straight to your inbox. Real estate is no longer a set-and-forget investment, guys. You have to stay on top of compliance. Okay, so how exactly are they calculating income that doesn't exist? It actually boils down to 3 really simple steps. First up, we establish the baseline. That's your gross annual value, or GAV. Since you aren't actually collecting rent, this is basically the expected market rent, whichever is higher between the fair rent or the municipal valuation. Step 2, you subtract any municipal taxes you actually paid that year. And step 3, that's simple math, leaves you with your net annual value, or NAV. But hold on, don't panic yet. We don't actually pay tax on that whole NAV. The tax code actually hands us some brilliant tools to shrink that number right down. Let's actually walk through the math to see how you can slash that phantom bill. Imagine your expected market rent. Your gross annual value is 4,80,000 rupees. First, you deduct those municipal taxes, let's say 10,000, leaving a net annual value of 4,70,000. Now here is where the magic happens. You immediately get to take a flat 30% standard deduction. Boom, that is 1,41,000 rupees, completely wiped off the taxable amount, no questions asked, just to cover general maintenance. Then you subtract your home loan interest for the year. Let's call it 3 lakh rupees. Just like that, your taxable income plummets from nearly 5 lakhs all the way down to just 39,000 rupees. And speaking of that home loan interest, there is a literal game changer hidden in these rules. For your standard self-occupied property, your home loan interest deduction is strictly capped at 2 lakh rupees, period. But for a deemed let-out property, our vacant 3rd house, there is absolutely no upper limit on the home loan interest you can deduct. No limit. So if you've got a heavy mortgage on that vacant third home and you're paying, say, 10 lakhs in interest, you get to deduct that entire 10 lakhs against the rental income. This unlimited deduction can completely wipe out your phantom rent and honestly, even create a loss that you can carry forward to future years. But what if you own the place outright? No home loan to offset the tax. Well, your restructuring option essentially boils down to one simple choice. Either rent it out to an actual tenant or sell it and reinvest in 54EC bonds. If you rent it out, you've got real cash flowing in to cover the tax bill. But if you sell, that unlocks some of the most powerful tax exemptions we have in Indian real estate, which is absolutely perfect for those of you who just want to totally exit the property management game. Let's look a little closer at this 54EC bond escape route. If you are just totally fed up with empty properties, phantom taxes, and the headache of dealing with tenants, sell the flat. To completely legally bypass the massive long-term capital gains tax on that sale, you simply park your profits into Section 54EC bonds like REC or PFC bonds. You can put away up to 50 lakhs per financial year. Yes, the money is locked in for 5 years, but it earns a solid annual coupon rate of around 5.25%. It's totally hassle-free, it legally wipes out the capital gains tax, solves your phantom rent problem forever, and gives you a nice passive income stream. Also, for all of you keeping tabs on the new tax code coming our way, here's your 2026 Section 23 update in one line. The old deemed rent rules map exactly to Section 21 of the new Income Tax Act. That's it. The core rules, taxing the third vacant property, the two-property limit, that sweet 30% standard deduction, none of that is actually changing. They're literally just picking up Section 23 from the 1961 Act and dropping it into Section 21 of the new 2025 Act, which rolls out in April 2026. Different name, exact same phantom tax trap. All right, so we've covered the trap, the math, the deductions, and your escape routes. Seriously, the absolute worst thing you can do right now is just ignore an empty property and cross your fingers that the automated tax systems won't find you. They will. If you want to see exactly how these numbers play out for your specific situation, DM me the word phantom right now for a free deemed rent calculation. But I want to leave you with a bigger question to chew on. In a world where housing demand is completely through the roof, is taxing an empty asset a massive government overreach? Or is it exactly the tough love we need to finally unlock all these vacant homes? Think about it.